Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another fine week in the market. Actually, the market was kind of dead. Not moving around a lot. In fact, it hasn't really moved a lot in the last couple of years. If you look at it, it's only about 14% higher than it was 2 years ago. That's over 2 years. Okay, so it's not the... I'm kind of perplexed when an awful lot of people going, well, look how much market's up. Like, really? Not that much. Talking about 6-7% a year is not a huge number. And if you take out the top 50 stocks out of the S&P 500, that number drops to negative. So, very misleading. And that's one of the things that is so tricky about the stock market. There's so many things that you need to know, and there's no one set and forget solution. I wish there were. I wish there were. That would be so nice. But that's not the world we live in, so we just keep working. Keep doing your best. Go to bullingtoncapital.com, by the way. We've got a seminar coming up that is, I think it's going to be pretty cool. We're launching some new services slowly. It's going to help people in a big way. We're actually trying to get up to speed on it ourselves. So this is kind of the unveiling of the service. We haven't been providing it to anybody as of yet, or at least nobody has signed up to use it. But I think it's going to be a really nice tool for everybody to have. One of the tough things about doing well financially is keeping track of what you're doing. That's incredibly difficult. And I can tell you that my better clients, and when I say better, I mean the ones that are easier to work with, they are very aware of what they're spending. That's the key. They're aware of what they spend. So financially, they're aware. And that makes it so much easier for us to be able to help them and add a lot of value. So I was thinking, what are the tools? What kind of tools can we get to help the average person track what they're doing so that they can see what direction they're headed? I mean, think about it. If you don't know where you've been, how do you know where you're going? How do you know which direction you're pointed into? And that's kind of basic, but it's also very important. So we're going to be unveiling this. It's a very nice service that we're rolling out to clients, where you can pull in all your accounts. You can see everything in one place. You don't even have to show me, by the way. All I can see is the stuff that I'm managing, unless you elect to share it with me. So I think it's really going to be fascinating. Anyway, I'm going to take a phone call, and if you'd like to call 216-901-0945, 216-901-0945, and I got Jerry. Jerry, how you doing?
Good morning, William. Beautiful day out, isn't it?
Yeah, it is. Yep.
Gorgeous. I have two questions, sir.
Sure.
One, your commentary on the Amazon purchase or announced purchase of Whole Food Markets, and how that's going to impact the future of grocery and internet shopping.
And it'll be very interesting and extremely interesting. Amazon's generates a ton of dough, and they're not afraid to reinvest or even borrow money if they don't have the cash flow themselves. And they're extremely aggressive. They will, I'm sure, they're going to try and give a big run to all the grocery stores. And by the way, Whole Foods Markets is a super high-end grocery store. When you go in there, it's all organic, and they know how to charge. They're kind of like the Apple of grocery stores. They charge the premium.
I was going to say, you think Amazon can do anything to bring the price point down and increase profitability or maintain profitability?
I don't know, but what's really interesting is, Amazon started putting up these little retail stores where you could go in and pick up the items that you ordered online.
Uh-huh.
And now they'll just, I can't imagine why they wouldn't put that in the grocery store. So now I'm going to go to the grocery store and I'm going to pick up that other stuff that I ordered online. Yeah. And so I think there's probably a good synergy there. And if anybody knows logistics, Amazon knows logistics.
Right.
Amazon is the new Walmart. Walmart crushed all the discount store chains because their logistics were better. They were able to sell at lower price points. And Amazon's the new Walmart.
Would you be a buyer of Amazon on weakness?
Not on that. Not just on that idea.
Not on that idea, but I'm talking about on weakness. Would you buy Amazon, or you think it's got? I've
owned Amazon throughout the years, and you've known me long enough to know that if it meets the criteria, I own it. Okay. If it doesn't meet the criteria, I don't. And I can tell you right now, I don't own it currently.
Okay.
So, but that doesn't mean to say that at some point in time I won't. It's just, as the price moves up, it's not in any one of the models currently. And it's been in them several times. And it's been relatively decent. But, like a stock, and everybody wants to get that one stock that they can just hang on to forever and is going to reward them and make them, bring it home. Well, it's kind of like winning the lottery. I mean, it's actually not quite as hard as winning the lottery because there are only 30. Yeah, there are only several thousand stocks that you could pick from, and in the lottery, you got to win out of billions.
Billions, yeah. No, you're right. All righty. Second question: the whooping that the technicals and the Nasdaq took back about a week and a half ago.
Oh man, they got pummeled.
It was pretty brutal. It's come back a little, but it's still. I mean. What's your opinion about the Nasdaq?
I don't know that
generally.
Yeah, that looks like just at this point, it looks like just a normal correction after you've had a great big run. That's what my opinion was. I'm like, these things have run a mile. I mean, you look at the look at the QQQ. Now the symbol for the Nasdaq, the 100 Nasdaq 100. Mm-hmm. And that thing has just been on a tear. It broke out to a new high back in December, and had been running and was up, the entire index. And these are not small companies; these are gigantic companies.
Sure.
And they were up 20% in less than 6 months. The whole index. One stock that goes up 20%, that happens all the time. But you take 100. Super large mega cap companies that are up 20% in less than 6 months. That's a big move. So when you look at the chart on that, you're like, it just kind of looks like it's normal, normal correction at this point. But so I wouldn't be surprised if it lingered around here, maybe even went a little bit lower, but then took back off again later this fall. Because when I look at the valuations on a lot of those stocks, a lot of them are not too bad. And
that's my opinion also. Yeah. Would you be a bank stock on weakness? Or would you purchase a bank stock or a bank stock index on weakness?
Not really. I look at the valuations. Okay. None of them are compelling. Like for me to buy something as an investment that I'm going to go out of my way, it's got to have compelling. It's got to be almost, super simple, which I can tell you right now, I don't see any that are super simple. But and the ones that are
with that increase in the discount rate and whatever, I just was wondering if that might have changed their mind. But I think everybody's figured it's going to be going up, but seeing it happen always gives a little impetus to what's going on.
Yeah, I'll tell you what's really funny, kind of funny. I'm pretty sure Trump's not aware of this. When you raise interest rates like that, 0.25%. A tremendous amount of the federal debt is revolving debt. Okay. So you've just raised the total interest payments probably by 25 billion or so.
Oh, sure.
Which is not super significant when you have a $3.2 trillion budget But it is $25 billion that you're not going to be able to spend in other areas.
It comes away from the bottom line.
Absolutely. It reduces government spending on the economy and forces them to pay more just on the interest service.
Sure.
That alone is troubling, for an economy, especially an economy that's not growing too strongly. But the second part of this is that they announced that they're going to start to unwind their balance sheet. And let me explain how this works. And this is why everybody on the planet, in fact, they should take this class. You take it your sophomore year when you're an econ major. It's like the third or fourth class you take, okay? And it's called Money, Credit, and Banking. I don't know what they call it today, but that's what it was called, in the ancient history when I was going to school and we were, writing on stone tablets. But the Money, Credit, and Banking. And what you learn there is basically how the banking system works. And this is why I'm so confident in the United States. I've had emails through the years, you're way too happy. I'm like, no, you don't understand. We can solve all of our problems. We have set this up. This was set up centuries ago. Banking is nothing new. Banking is way older than this country is. Banking is almost as old as society is. Okay. And a fractional reserve banking system works the best. That's why we use it. That's why China has tried to incorporate it. That's why Russia has tried to incorporate it. That's why Germany, England, France, those countries had that way before we were even a country. Okay. So it's a system that works. It doesn't work like people want it to. People want perfection. Well, good luck. And especially in anything in life,
right?
And particularly not your banking system, but it does work well. And here's how it works: when the economy starts to overheat, you can actually raise interest rates. That'll do something to slow it down, but you know what? Typically, not as much as people think it does. What really affects the ability for people to borrow money is the Fed's whether they're buying or selling bonds, because when they buy bonds, they're buying the bonds, putting them on their balance sheet, giving the cash to the banks so the banks can go out and make a loan. Does that make sense?
Yes, it does.
Yeah, they're not going to sit there on the money. They don't get paid doing that. Okay, so they're going to make loans if the Fed is buying the bonds. And that's why the Fed was buying all those mortgage-backed securities back when they were collapsing, because when the value of those loans goes down, it restricts. There's twofold. First of all, they've already lent the money. Secondly, the reserves that they have are dropping, which inhibits their ability to lend even more. Okay, so if we take that money and the Fed buys those back, that gives a lot of relief to the system. It's like getting a blood transfusion when you're lying on the operating table. That's probably a pretty good idea. Yeah. And so now they're starting to say, hey, we're gonna unwind that balance sheet. And a lot of people are going, yay, and I'm going, uh-oh. you don't understand. When they start selling those selling those bonds back to the banks, a lot of the banks are not going to have a choice. They're going to have to take those bonds back. Okay, it's going to take
right.
It's going to take money out of their ability. It's going to restrict their ability to make new loans, and that will have a big time chilling effect on the economy. And I kept saying, Trump, you better leave Yellen alone. You better leave Yellen alone. She can make sure you are a one-term president. And I don't know how far they'll go. A quarter of a point is not going to do a lot. Whether they actually follow through or they just sell a little bit, they start unwinding the balance sheet slowly. That'll all have a big impact on that. But the bottom line is both of those moves are restrictive. They're designed to slow the economy down. Not even necessarily, but it's some of the controls that they have. They used to call
moderate things a touch. Yeah.
Exactly. So having that come up, I'm going, that's not real good. It's not a dangerous position. They're not going to do anything like Paul Volcker did, where he raised, short-term interest rates actually got up to 18% at some point in time. But that'll all take a long time to happen. But and it's actually good to see that they have enough confidence to go ahead and start unwinding that balance sheet. What they're saying is that, look, we think the economy is doing pretty good, and we think that it can withstand this. So,
exactly, it's just a matter of how much stress you can put on the patient.
And if you're buying bonds out there, you should not have maturities longer than 5 or 6 years.
I would not be buying bonds in this market just because the rates are going up. I think that'd be very foolish. But that's strictly my opinion.
It's not foolish to people who don't know any better.
Well, I hope I know better.
Yeah, but I will tell you that the vast majority of investors don't have the same level of knowledge that you do, particularly the kids in their 30s. They don't understand. What they look at is, what is the current yield? What's that thing yielding?
Sure.
It's paying 4%. CDs are only paying 1.2. Yeah, well, see, there's a reason that's paying 4% because there's a risk there, and you've got to learn how to see that. I can tell you right now, that is a lesson that young people are going to learn, and they're going to learn over the next 5 or 10 years. They're going to invest in a lot of bond funds because they sound safe, and they're not going to make any money, or they might even be negative. Okay, so,
well, by the time you get to be people of your age or my age, we've taken plenty of lumps on our own, so I suppose they're entitled to get their lesson.
Well, and it's unfortunate that they have to learn it that way, which is what I'm trying to save them from. Don't do that. Look at the what's really funny too is they announced that interest rates were going to go up. And a long-term Treasury ETF actually went up that day. So a lot of the younger people or more inexperienced people are going, he doesn't know what he's talking about. No. It's still down 12% from where it was in July this time last year. Okay, so it's got to go up a long way to make that money back. And the reality is there's this thing called a relief rally. The news comes out, it's not as bad as they expected, so the thing moves in the opposite direction that it should because they're relieved it wasn't more. And inevitably, though, when you raise interest rates, it's not a matter of if, it's when the bond prices will drop. They can defy logic just like stocks can. It's like the stock market, just like anything in life, actually. It can defy logic, but it can only do that for so long. Eventually, just like
common sense will prevail.
Yes, and the fundamentals prevail. So, but
all righty, very good, William. Thank you so much for your insight. Have a great afternoon, and take care.
Thanks for calling.
Yep.
If you'd like to call 216-901-0945, 216-901-0945. Only here to help, folks. I'm trying to help, and even when you know what you're doing and you're doing the right things, it can look pretty foolish over time. Hey, I got to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because I'll be right back. And we're back. Hey, I got to go to the phones right now. Number is 216-901-0945. 216-901-0945 if you'd like to call in. And right now I'm going to Rick. Rick, how you doing?
Hey, Bill. Thanks. I'm looking at Transocean.
Okay.
And just wondering what you think.
Well, are you looking at it as an investment or a trade? That's the first thing I would say.
More an investment.
Okay. I would actually have to look up their balance sheet. I can hold on. And this is just what I call the 60-second test, except that I can do it in about 10 seconds because I've been doing it for so long. And what I'm going to do is I'm going to look at the sales and the profit margins and the averages over the last 10 or 20 years. And that's all, by the way, on a service called Y-Charts. I'm not doing that. That's not magic. This is what this company does. And I can give you an idea. But I have to tell you, companies like these that are heavily dependent on petroleum prices are incredibly difficult to forecast for. I mean, incredibly difficult. And the same level of difficulty as predicting how many points the Browns are going to score next year in the entire season. Well, maybe not quite as hard, but it's close because you have to know what first of all, you got to know what the prices of crude oil are going to be. And if you can figure that out, man, I can show you how we can both get super rich. I mean, you have to be accurate, though. It's got to be really accurate. Anyway, if I'm looking at the value of the company, the market cap of the stock, actually, not the entire market value of the company, at 3.37 billion. They had 3.6 billion in revenue in over the last 12 months, and the revenue was down 41% from the year before. So their earnings were a loss. Looks like, I take it back. The growth was minus 64%. See, when revenues drop by 40%, your profits drop faster because your fixed costs never go away. Does that make sense?
Okay, yeah.
Your fixed costs stay fixed. So if you got less revenue, your profits will go down faster than your sales will. They still did have a profit, and the profit margin is still actually pretty healthy. I would look at this, and I'm not super enthusiastic about it because the market value of the stock being fairly close to the revenue is still relatively high for a company in that industry over time. Now, if crude oil prices go back up to $100 a barrel over the next 12 to 18 months, all bets are off. This thing could go, back to $50, which is where it was in 2013. So,
yeah.
But it is your guess is as good as mine, quite frankly. Your guess is every bit as good as mine, and we're both guessing. The analysts that are covering this thing are guessing. They're guessing. They're paid a whole lot of money to try to guess, and I got to tell you, at this point, their guess is as good as yours or mine, because there are just some things you cannot know. You can't know what petroleum prices are going to be 2 years from now. If you knew that there would be a ton of billionaires walking around, because all you'd have to do is buy a couple of out-of-the-money call options on a futures contract for petroleum, and you would be super rich. So anyway.
Well, I thought you might say something like that. I'm just looking at it. I mean, it's at historic low.
Yeah.
And
well, I've seen the valuation on it is not as low as other companies that are similar and do similar things. So to be nearly 1 times revenues is not a low valuation. If you're at a quarter of revenues, that's a low valuation. So it's kind of like real estate. You go into a neighborhood, if there's a house there that somebody listed for $600,000 and all the other houses are selling for $125,000, and then the house comes down, they finally realize they're not going to get $600,000. They bring it down to $250,000. Hey, that's an all-time low. Is it a deal yet?
Yeah.
No, that's kind of what I'm talking about. But so those are hard,
okay.
Man. Those are really hard. And if I were to do something like that, I would probably buy an out-of-the-money call that would go out 2 years from now, or at least 18 months from now, and I would not put a lot of money in it because that is a bet. That's not really an investment. That's a bet, and it will make way more money than that stock will. And if you're wrong, you won't lose too much because those things will move like $10 for every $1 that stock will move. So.
Okay.
All right. Well, I hope that helps a little bit. But
okay, appreciate it.
All right. Have a good weekend.
Okay.
Yep. Bye-bye.
You too. Bye-bye.
Thanks. Yeah, that's, by the way, symbol for that is RIG, and very interesting. They do offshore contract drilling, and so you never know. That's the thing about stocks, and if you're going to be an investor in stocks, I would recommend sticking to companies that are in businesses that will still be in the same business, doing business relatively similarly, not always, like Hershey's. Hershey's, 10 years from now, Hershey's will still be making chocolate, and it's still going to taste like chocolate, and it's still going to have the same ingredients. Now, how much those ingredients cost, that's always a factor. But Hershey's has been around a long time. Chocolate's been around a long time, probably going to stay that way. When you're looking at a company that's crude oil, with the electric cars, with the solar gaining ground every year, it's improving. And I know it's a long way off with the, my mind is going on me now. Fuel cell cars, that's a big deal. fuel cell cars run on hydrogen. Hydrogen is the most abundant element in the universe. We don't have the infrastructure in place just to switch from petroleum. That's going to take a long time. In the last 100 years or so, we've been building up all this infrastructure to support petroleum. That's not, for number one, that's not going to go away overnight. Companies that built that and have invested in it have vested interest in seeing it remain. So you got that to deal with. Secondly, they have a big edge right now in the cost, because to put the infrastructure in for hydrogen is very expensive. And over time, I think that'll be part of the solution. And I really believe, based on all the reading that I do, at some point in time, the technology regarding solar is going to get so much, it's going to improve so much that will be a main contributor towards all sources of energy. And it doesn't really matter whether you believe that or not. Quite frankly, I don't care. What I'm really worried about is people getting in and buying and holding on to companies that just hold them, expecting that, that's a good investment strategy and that they're going to be rewarded for that, because you don't know. There are way too many unknowns. And one of the things, by the way, that we'll be talking about at the seminar upcoming. In fact, you know what? I forgot what date it is. I'll have to go look that up again. We're going to be looking at keeping up with change, and markets are constantly evolving. They're constantly evolving, and I'm going to be talking about how you keep up with that change. In fact, some of the better opportunities, I think, investment-wise, are right now they're outside of the United States. Now, you could have said that for the past 4 or 5 years, because it was even more true back then. But those markets have not kept up with ours. They're not even close in the performance over the past 5 years. They are not remotely close. So if you've had exposure to that, you're probably a little dissatisfied right now. But I'm here to tell you that those companies are not going away, and their valuations are cheaper than ours. That example I just gave, a $600,000 house in a $250,000 or $125,000 neighborhood. These are houses selling for $99,000 in the $125,000 neighborhood, when our houses are selling for $140,000. They're not super overpriced, but they're a little overpriced. Theirs are underpriced, and when they close that gap, I think people that are investing in those things are going to be pretty happy. And so part of the Department of Labor rules that have come out lately, which have had very little in the way of guidelines as how you're going to invest. They keep saying that, you have to do it prudently, you have to do it prudently, and then they don't define what prudent is. A typical government document. But anyway, I think a part of that is having exposure not just to the United States, but I think getting outside of the United States. The time has come. I really believe it's come to be looking at that and starting to add that. So you're a client, you can bet you're getting an email or a call, and we're going to start to add some of those things. And since I don't do any management in those areas, I'm going to try to identify the best managers in their spaces. And we've gone through training, subscribed to a new service that has, I forget how many tens of thousands of funds and outside managers that are in this database. And this is what's really wild. A database like the one that I have subscribed to, and where you can do all these manager searches, individual portfolio managers, variable annuities, 401k plans, you name it. A database like that 10 years ago could cost as much as $60,000 a year. That was what you paid for access to the database. Now I'm only paying $3,000. Think about that. How'd you like to be in that business? You were getting 60, now you're getting 3. Wow. The only benefit that they really have is that, at 3,000, there are a lot of other firms that can subscribe to these things. It makes it more, you're going to try to make up for the lack of revenue by increasing the volume, the number of people that have signed up for it. And it's still kind of expensive, but, for an individual investor. But for small companies, not bad at all. And it's fascinating. It is fascinating. You can create a search, a manager search, based on any criteria that you can dream up. And as far as I can tell, if you can't get by with the few hundred options that are pre-programmed, they'll write it for you. So if you tell them, I'm looking for this, they'll actually make a change to that. So pretty neat. It's amazing how technology has changed so many things and is going to continue to change things. You know, I'm looking around at the potential for change, the potential for growth. You know, we haven't had a whole lot of growth here in quite a while. Housing and automobiles, banking, that has picked up. That's picked up a lot over the past 2 to 3 years. The first 2 to 3 years after the big recession, they were struggling, but they've picked back up. And that's, you know, you're talking, if you combine those 3 areas of the economy, it's over a third. It's over a third of the economy. And it has a big impact on a lot of others. So that's nice to see that that's actually picking up. It'll be nicer to see if the return, the performance would start to spread out, because it's been pretty much into some really huge companies, which is kind of typical. You know, when big companies are leading the market, it's typically because the market's had a big scare, and those are the most trusted names, and that's where all the money goes. Having said that, an awful lot of the money that has come into the market in the past 6 or 7 years has gone into market cap weighted approaches. Anybody that's been to any of my seminars knows that is one of my least favorite ways to invest. And the novices or the new investors look at market cap weighted index. They have no idea what that means, or the fact that the funds that they're investing in are investing in the same stocks that are the biggest components of those market cap weighted indexes. And I'm here to tell you, they're not cheap anymore. They're slightly overpriced. I feel like the same way I felt like in the late 90s when you kept saying, yeah, but this is great until it ends. And then when it ends, it tends to end badly. And I think those funds, they've already started down that path. Now, the good news is it's nowhere near the extent that it was in the year 2000. Those stocks are not selling at prices that are 2 or 3 times higher than they should. They're selling at about 25 to 30% higher prices than they should. And even if they come down, it's not going to drive the stock market or the S&P 500, what a lot of people refer to as the stock market. It's not going to drive that down more than 10 or 15% or so if those companies corrected and came back to where they should, because those aren't the only companies in the index. And that money, more than likely, being given the fact that it has to stay invested in stocks because of the prospectuses of the funds, will be redistributed into some of the other names who haven't participated in the rally over the past 2 to 3 years. So it's a tough time for anybody who's been paying attention purely to value as an investment. If you've been looking at value as an investment, there's a pretty good chance that your portfolio has been lagging the S&P 500 or the Russell 1000 or any of the market cap weighted indexes. And it's all because of a popularity thing. It's not because those companies are actually underpriced and growing fast and moving higher. It's because that's where all the money's been going. And I know that probably doesn't make sense to an awful lot of people out there, which is one of the reasons I'll probably always have a job. It also makes my job pretty difficult because, you know, you just don't get it. And it doesn't make sense, and it doesn't make sense, you know, until you've been, when you're a seasoned investor, then it makes sense. Yeah, if people keep doing something, it's going to keep working until they stop. And unfortunately, they don't tell you when they're going to stop. It's not like musical chairs where everybody hears the music stops, you know. It's actually, well, it is like musical chairs, except that you are required to wear earplugs. So you're only stopping when you see everybody else who doesn't have the earplugs in stop, and they're always beating you to the chair. Anyway, I hear the music. That means I have to take another quick commercial break. Hey, when I come back, we'll talk about some individual stocks, and you can call us 216-901-0945 if you'd like to. Stay tuned. I'll be right back. If you'd like to call us with a question, number is 216-901-0945. You're listening to Bill Bullington. I'm here every Saturday morning from 11 noon on 1420 The Answer. And I'm going to go right back to the phones. Is this the same Rick?
Yeah, good morning.
Hey, how you doing?
Good. How you doing?
Hanging in there.
See, wanted to get your thoughts on target date retirement funds and whether you think those are appropriate for someone within 10 to 15 years of retirement.
I think if you're not working with an advisor, or if you're not really willing to put in a lot of elbow grease and sweat equity, then yeah, that's what you should do. Absolutely.
Now, do they invest in funds of that particular mutual fund company? Is that how?
Well, they're all different. You have to look at the actual funds that you're considering, and in the prospectus, it'll tell you exactly how they're invested. And I know that's probably not what you wanted to hear, that you're going to have to read a very complicated document, but unfortunately, when you're doing it yourself, you have no other choice. So you have to read the document. It will tell you exactly how they're going to invest the money.
Is it essentially just a combination of large cap funds or large cap stocks and bonds? Some
of them are, but you have to go back to that prospectus and you got to break it out because they have all different kinds. And one of the things that I can see somebody may get in trouble with is if you expected all large cap in there and they had international emerging market and you're wondering why that fund is lagging behind the balanced fund index, and that would be the reason. So, and you wouldn't know that unless you spent time reading that prospectus or you were working with an advisor that read it for you and said, okay, here's where, this is what they're doing, this is what they've got, and here's what we would expect, to happen. And then you can compare it to the benchmark to see if they're keeping up with that. So a lot of effort involved, and unfortunately, there's no quick or easy answer to that.
Mm-hmm. Would it make sense to try to construct your own target date retirement?
I think so. In fact, here's something I like to do. It's a little more aggressive than, it's considered more aggressive because the data over the last 10 years would tell you that you should have most of your money in large cap stocks because those over the past 10 years, those have done better than most of the other asset classes. But going forward, when you're looking at the large cap valuations, when you look at Sherwin-Williams or you look at Colgate-Palmolive or Procter & Gamble, those things are priced, slightly above where they should be. Yeah, they've done great over the last 10 years, but they were more undervalued back then than they are today. So personally, I would rather have some international emerging markets which have done squat for the past 5 years and their 10-year track record looks pretty crappy. But if you go back to before World War II or before World War I, there are companies in those indexes that have been around longer than we've been a country. And their long-term track records are actually better than ours. So what would you rather do? Look at something that's just outperformed or look at something that's underperformed but in the long run has a track record that's better?
Mm-hmm. Right.
It's very counterintuitive because most people say, well, I want the better one. I hope that works out for you. I hope they just keep on going and get more overpriced. No, actually, I hope that doesn't happen. Because then the wailing and gnashing of teeth occurs when that correction comes. So I think if you were to overweight, you would look at international and emerging markets now and make at least maybe as much as a quarter of the stock portion of your portfolio. And so I think you'll be very well served doing that. It is kind of funny. I won't name the company. And there are tons of companies, money management firms with the name Black in them, so I'm not really calling them out. But there's a major company that was overweight international emerging markets over the past 5 years. And last fall, because they knew the same thing I knew, those things had underperformed and their economies were growing faster. Their valuations are lower than ours are. It's just a matter of time before that reverses. So they were early to the game, and they were actually early by a few years. And people got so disgusted with the performance that they pulled most of the money out. So they changed their strategy. And about a month after they changed their strategy, those categories that they were overweight in started outperforming. And by the way, I'm laughing because that's happened to me so many times. Investing is tough, man. You've got to get in and you really got to stick to your guns. If your logic is sound, sooner or later it's going to work out. But if your logic is not sound, well, then there's no help for that. That's one of the reasons I think target date funds probably make a lot of sense for a lot of people. If you really don't want to know much about it, you can pick up the year that you're going to retire and then pick that fund that has the same year in it, and they'll try to take care of all that for you. Could you do better on your own? Maybe. The chances of you being able to do that if you're not going to spend an enormous amount of time are probably pretty remote. But you never know.
Yep. Okay. Very good, Bill. Thanks very much.
Hey, thanks for calling. Yep. Bye. And if you have a question like that, you can always call me. And by the way, I mentioned I was going to talk a little bit about stocks. And look up for the Bull website. And I'm one of the very few investment advisors I know that has ever managed money or a portfolio, and I'm still managing. And by the way, one of the other strategies that hasn't worked well at all has been momentum, and in all of its shapes or forms. And that's very cyclical. That happens. You have not had the economic environment that supports that particular style of investing since the recession. There's been a 9-month window in the past, 6 years now. You want to talk about having to have a lot of patience. Holy cow. It's not that it hasn't made any money. In fact, the first couple of years right out of the recession, it did extremely well. But you look over the past 5 or 6 years, that thing, in the past 3 years in particular, anything that was related to momentum has really suffered. And it's not because, at least you don't really know this for sure. It may be broken. It may never work again. Nothing may work again. You can't say something. You're not allowed to guarantee anything. But I can tell you, the economic environment, when momentum-based strategies, the ones that built the Fidelity Trend Fund back in the 60s, the ones that built Janus and 20th Century back in the 80s, and in the 90s, there were a whole ton of funds that came out and flamed out, quite frankly, because they were just pure momentum and had no valuation, no other backstop. Well, those things will come and they'll make an unbelievable amount of money. Maybe some of you remember the PBHG Growth Fund. And Gary Pilgrim, his initials were half of that fund's initials, Pilgrim Baxter. And I remember seeing him on television saying, mark my words, one day that fund is going to crash. One day the fund is going to crash. And I'm thinking, he's talking about his fund. And he's talking about his fund and he's telling the truth, because I already known that was a very cyclical strategy. And then I found out about a week later that he'd already sold the fund 6 months prior to that interview. But at least he was still telling the truth. He wasn't in there saying, this is going to go like this forever. And it's very, very cyclical, and it's very painful when you're in a strategy that underperforms. And by the way, during the late 90s, that was all the rage. 5 years, it was smoking what's working today. What's working today is basically market cap weighted indexing. That was doing very well too, but mainly because of momentum stocks. But the value-oriented stuff, the value-oriented investors back in the late 90s, they were being fired left and right, and they were still doing the right things. And people found out in the year 2000 when the NASDAQ began its historic fall that ended up being 67%. And these funds went up that year, and they outperformed by a mile, caught up and then passed the performance of all the momentum-based funds. And that's the frustrating part about investing, is you got to pick your poison. Are you going to be the momentum, or are you going to be value? Either one, you're going to lag the market for some fairly long time periods. And it's very difficult. If you think it's easy, give it a shot. But, having said that, one of the logical things to do is to invest in some large company stocks, invest in some small, medium-sized company stocks. try to get some pretty good overseas and international and put it together in a portfolio. And by the way, that's one of the things we're doing this year for sure. We don't have a lot of international or emerging markets, and I'm going to recommend that everybody go back, and I'm going to pick the managers I feel like have done the best job in their categories, and we're going to stick with those guys until they stop performing well, after they move. You know, we have to keep up with that stuff. Just because they were good at one point in time doesn't mean they'll continue to stay well. When the manager leaves, you know, the fund doesn't have its own track record. It's actually the manager that owns the track record, although all you see published is the fund's track record. The managers leave, they don't, quite frankly, and they have to tell you, but the way that they tell you, hardly anybody pays attention to it. So anyway, I catch myself rambling here. We're going to be having a seminar, and that seminar is coming up relatively soon. We'll be talking about all this stuff and the new technologies to help you stay on track with your investment and financial plans. You can go to my website. It's actually this summer, we do them in the morning before the radio show, so it's going to be 8:30, July 22nd. You can go to my website, bullingtoncapital.com, to sign up online. It's free. I think you're really going to like this, by the way. We're calling it a financial dashboard. It is really cool, the technology that's available to try to help you manage and invest your investments. Not just that, but your entire financial life. So I hear the music. That means the show is over. Thanks again for listening this week, everybody. Have a good week, good investing, and good luck.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.